Hello students, welcome to BBA 204. Today I will talk about part 1 of chapter 19. We will discuss about how to manage quality and performance in the workplace. I will also talk about feedback control model as well as the balanced scorecard perspective. I will define organizational control and explain why it's a key management function. As we know from the day one of this class, managers use a variety of measures to monitor and measure performance. These different ways of measuring performance includes controlling work processes, regulating employee behavior, designing systems for financial resources, developing human resources, and evaluating the profitability of companies. Control, especially quality control, is an issue facing every manager in every organization today. So if you pick up the news or look at the front page of Business News or New York Times, you will always see a problem related to quality control in firms. So the key question is then, how do companies manage quality control? How do they make sure that controls are established in the strongest way possible within the companies? Control is a key management function because it is the mechanisms managers use to steer the organization towards its objectives. So organizational control is a process of ensuring that objectives are met and that resources are allocated in the best way to achieve those objectives. Here are the 4 steps in the control process. The first step that the managers engage in is to establish standards of performance. Managers define goals for organizational departments in specific operational terms that comprise a standard of performance against which to compare organizational activities. So what are those examples of performance? For example, in our department or in our jobs, the academic performance is measured by academic productivity. It is also measured by teaching evaluations. Those are the standards of performance that we set for each faculty in the department. So each faculty is expected to do research and publish. Each faculty is also expected to do a good teaching record, to keep a good teaching record. And the other step that the managers are involved in is to measure actual performance. Managers develop quantitative measurements of performance that can be reviewed on a daily, weekly, or monthly basis. For instance, again in our departments, we have something called annual evaluation reports, annual performance reports, or annual evaluation reports. So we fill out those forms or we write an annual evaluation report by self-reporting ourselves or our activities to the department chair. And department chair does our performance evaluation on a yearly basis. And then the third step that the managers are involved in is to compare performance to standards. So what is the actual performance and how does the actual performance compare to the established standards? So this is an explicit comparison of actual activities to performance standards, right? And the last step is to take corrective action. Managers also determine what changes, if any, are needed. Let's say in my annual evaluation report, if I indicate that I have published 2 articles during the last 2 years, then when the department compares my performance to the established standards. So what do the established standards say? We should publish an average of 1 article per year. So if I publish 2 articles in the last 2 years, it means that I am comparing well according to established standards. It means that I am satisfying, or I am meeting the established standards. But if I am behind those established standards, I should take corrective actions. To make sure that I should take corrective actions, to make sure that I do not fall behind the established standards. Here is the feedback control model that I just talked about, the 5 different steps of the feedback control model. Now let's talk about another approach, another control model, which is also known as the balanced scorecard. The balanced scorecard is especially useful to track the performance and control of the organization. What is important about the balanced scorecard is that it provides a very balanced perspective of company performance by integrating various areas of the organization. Okay? It provides a very balanced perspective by integrating various areas of the organization. As we see here in figure or chart 19.2, the balanced scorecard is a comprehensive management control system that balances traditional financial measures with operational measures relating to a company's critical success factors. Right? So a balanced scorecard contains 4 major perspectives: financial performance, customer service, internal business processes, and the organization's capacity for learning and growth. The third perspective is the budgetary control. Budgetary control is important because budgetary and financial controls tell whether the organization is on sound financial footing. They also tell whether financial controls can be useful indicators of other kinds of performance problems. So, what is budgetary control responsible for? Budget controls set targets and monitor expenditures. Budgets list planned and actual expenditures. But most importantly, budgets and financial controls tell us whether the organization is on sound financial principles. Budgets are a useful tool for planning an organization's expenditures. So here are different types of budgets that managers use: expense budget, revenue budget, cash budget, capital budget, and zero-based budgets. So let's go through each of them, starting with the expense budget. So what's an expense budget? Expense budget includes anticipated and actual expenses for each department and for the total organization. Let's say, what is the anticipated expenses of the research and development department versus their actual expenses. So this budget shows all expenses or focus on a particular category, such as materials or research and development expenses. When actual expenses exceed budgeted amounts, the difference signals the need for managers to identify where a problem exists and, if so, take action. So now let's look at the revenue budget. What's a revenue budget? A revenue budget lists forecasted and actual revenues of the organization. It's pretty much like the expense budget in a way, just like the expense budget that includes anticipated and actual expenses. The revenue budget also lists forecasted and actual revenues of the organization. What is the anticipated or forecasted revenue versus what is the actual revenue of the organization? Revenues below the budgeted amount signal a need to investigate the problem to see whether the organization can improve the revenues. Revenues above the budget require determining whether the organization can obtain the resources to meet the higher than expected demand for products and services. So what about the cash budget? A cash budget estimates receipts and expenditures of money on a daily or weekly basis to ensure that an organization has sufficient cash to meet its obligations. Cash budget shows the level of funds flowing through the organization and the nature of cash disbursements. If the cash budget shows that the firm has more cash than necessary to meet its short-term needs, the company can invest the excess funds. If the cash budget shows a payroll expense that exceeds the amount of money in the bank, the organization must borrow cash to meet the payroll. Now let's look at the capital budget. What does capital budget include? The capital budget includes planned investments in major assets, such as buildings, trucks, heavy machinery, often involving expenditures over more than a year. A capital budget is necessary to plan the impact of these expenditures on cash flow and profitability of the company. The zero-based budget. A zero-based budgeting is an approach to planning and decision-making that requires a complete justification for every line item in the budget. So instead of carrying forward a prior budget and applying a percentage change, we require a complete justification of every line item in the budget. For instance, a zero-based budget begins with a starting point of zero expense, and every dollar added to the budget is reflected by an actual, documented need, not by a percentage change. Budgeting is an important part of organizational planning and control. Many traditional companies use top-down budgeting. This means that the budgeted amounts for the coming year are imposed on middle and lower level managers by the upper level management. Whereas bottom-up budgeting means that lower level managers anticipate their department's resource needs and pass them up to top management for approval. So as you can see in bottom-up managing or budgeting, lower level and middle level managers have an upper hand. They have a more say in department's needs and make decisions and pass their decisions up to top management for approval. In the bottom-up budgeting, in other words, lower level managers are more proactive or are more proactively involved in the budgeting process. Now let's look at Financial control systems. Managers need to be able to evaluate financial reports that compare their organization's performance with earlier data or industry norms. Financial statements provide the basic information used for financial control of an organization. Financial statements provide the basic information used for financial control of an organization. We have two types of financial statements. Balance sheet versus the income sheet shows firm's financial position, whereas the income statement is a profit and loss, meaning P&L statement. It's a profit and loss statement that highlights firm's financial performance. Now let's look at the balance sheet. Let's start with what falls under balance sheet and carefully look at figure 19.3. Balance sheet shows the firm's financial position with respect to assets and liabilities at a specific point in time. It provides three types of information. On the left side, we have the assets. Assets meaning what the company owns. Assets refers to what the company owns, which includes current assets and the fixed assets. So under current assets, we have cash, accounts receivable, inventory, whereas under fixed assets, we have land, buildings, and machinery, and minus the depreciation. We always need to depreciate the fixed assets. Depreciation refers to the loss of value in the fixed assets due to passage of time. So we need to always deduct depreciation from the fixed assets because those fixed assets are always subject to depreciation, which is the loss of value in the fixed assets due to passage of time or due to wear and tear. And on the right side, we see the liabilities. Liabilities includes the firm's debts. Okay? The firm's liabilities includes the firm's debts, which includes both the current debt and the long-term debt and owner's equity. Okay? So the liabilities has three parts. Okay? Current liabilities, long-term liabilities, and the company owner's equity. Liabilities refer to what the firm owns, not what the firm owns. Liabilities refer to what the firm owes, meaning the firm's debts. The difference between assets and liabilities is the company's net worth in stock and retained earnings. So as you can see, under current liabilities, we have accounts payable. In other words, what the company is expecting to pay in the future or in the near future, accrued expenses, income taxes payable. And then in the long-term liabilities is what the company is expecting to pay in the long term, which is the mortgages payable, bonds outstanding. And in the last part, we have the owner's equity, the common stock and the retained earnings. Now, let's look at the income statement. As you see here, income statement is entirely different than the balance sheet, because income statement is also called a profit and loss statement, P&L statement. Income statement summarizes the firm's financial performance for a given time interval, usually 1 year. Okay? The bottom line indicates the net income, profit or loss for the given time period. So we start with the gross sales and then subtract sales returns from the gross sales, end up with net sales. Okay? And then the other important items on the income statement is the cost of goods sold, depreciation, sales expenses, administrative expenses. Right? But here is the most important part that you need to know. The gross income. After we obtain the gross income, we need to find the net income. So what we do, we first subtract from gross income the interest expense, right? To arrive at income before taxes. And then we subtract the taxes to arrive at net income. Okay, so this is an important aspect in the or a variable in the income statement. Gross income, after we arrive at gross income, we first deduct interest expense and then deduct taxes to arrive at net income. In other words, we're always deducting the interest expense first and then we deduct the taxes. We're deducting interest expense and then taxes to arrive at net income. Okay, if the net income is positive, it's a profit for the company. If net income is negative, it's a loss for the company. Managers need to evaluate financial reports. Financial analysis allows managers to be able to evaluate financial reports that compare their organization's performance with earlier data or industry norms. The most common financial analysis focuses on financial ratios, which express the relationship between performance indicators such as profits and assets, sales, and inventory. Managers decide which ratios reveal the most important relationships for their businesses. The most common financial analysis focuses on ratios. Liquidity ratios, activity ratios, profitability ratios, and leverage ratios are among the most common ratios. Here you go. The liquidity ratios, activity ratios, profitability ratios, and leverage ratios are among the most commonly used ratios. So starting with the liquidity ratio, it basically indicates an organization's ability to meet its current debt obligations. The current ratios, current assets divided by current liabilities, tells whether the organization has sufficient assets to convert into cash to pay off debts if needed in the short run. Okay, so a liquidity ratio is very, very important because it indicates the firm's ability to pay off its debt in the short run. Okay? Another liquidity ratio is the quick ratio, which is typically expressed as cash plus accounts receivable divided by the current liabilities. It is very, very important to know how to find those common financial ratios because those ratios indicate the financial performance of the firm. You must know how to find these ratios. Now looking at the activity ratio, what does activity ratio measures? Well, activity ratio measures internal performance with respect to key activities defined by management. For example, one activity ratio is inventory turnover. It's calculated by dividing the total sales by average inventory. This tells how many times the inventory is used to meet the sales figure. So we want the inventory turnover to be as high as possible. Higher inventory turnover indicates that the firm is selling its inventory. So higher inventory turnover is a good thing. Again, in terms of the liquidity ratios, we want the current ratio to be as high as possible. We want the current assets to be higher than the current liabilities, which means that the firm has a positive cash flow. If the firm has a positive cash flow, it is able to pay off its debt in a short period of time. The conversion ratio is purchase orders divided by customer inquiries. This ratio indicates effectiveness in converting inquiries into sales. Again, conversion ratio indicates effectiveness in converting customer inquiries into sales. So again, we want this ratio to be as high as possible. A profitability ratio states profits relative to a source of profits, such as sales or assets. The profit margin on sales is calculated as net income divided by total sales. The gross margin is the gross before tax profit divided by total sales. Gross margin is gross income divided by sales. Another important profitability measure is the return on assets. Actually, this is the most important profitability measure, ROA. It indicates the percentage representing company earnings from assets, computed as net income divided by total assets of the company. Return on assets is a very valuable yardstick for comparing a company's ability to generate earnings with other investment opportunities. A company should earn more by using its assets than it could by putting its investment in the bank. So therefore, this ROA is a very, very important indicator of a company's financial measurement because it indicates whether a company is earning more by using its assets than by simply putting its money in the bank. Finally, the leverage ratio indicates the long-term debt of the company. It refers to funding activities with borrowed money. A company uses leverage to make its assets produce more than they could on their own. Too much borrowing can put the organization at risks, such that it will be unable to keep up with repayment of its debt. So we want the debt ratio to be as low as possible, whereas we want the other ratios that we have discussed prior to be as high as possible. We want the leverage ratio to be as small as possible because leverage ratio indicates the debt position of the company, how much the company owes. And we find the debt ratio as total debt divided by total assets. Managers should track the debt ratio to make sure that it does not exceed a level they consider acceptable. Thank you for listening to my lecture so far, and in part 2 of my lecture I will talk about other financial control systems. Thanks again and see you in part 2. Have a good day.